Please subscribe, like, and comment.
So you might have seen the headlines recently. Gold prices have really gone through the roof.
Oh, definitely.
We're talking like hitting a record high of over $3,250 an ounce. That's as of mid-April 2025. It's enough to make you sit up and take notice.
Absolutely. And, to put that into perspective, the previous peak, that was around $2,070 back in 2020.
Right, I remember that.
Yeah, and that felt big then. But this latest surge, gosh, a 23% jump just since January 1st this year, that really suggests something fundamental is shifting, in the financial world.
Exactly. So for this deep dive, we've pulled together quite a range of sources. We've got financial reports, news articles, price data, to really try and dig into why this is happening, what's behind this incredible run in gold, and, what it might mean for the global economy.
Yeah.
Because I bet you're thinking the same thing we are. Why is gold suddenly like the thing everyone's talking about in finance?
That's the big question, isn't it? And that's what we want to explore. I think to get to the bottom of it, we need to first look at where prices are right now.
Okay.
And then sort of unpack the different factors, because they're all interconnected, that are driving this climb.
Okay, let's start there. The current picture. So gold's trading around, what, $3,255 an ounce?
Roughly, yeah, as of mid-April.
And get this, just in the past week, it's jumped 6.5%.
Wow.
Which apparently is the largest weekly gain since that really unsettling period back in 2020 with the COVID panic.
That is significant, yeah. It tells you something about the current mood.
It feels like it.
And what's particularly interesting, I think, is seeing how the big financial players are reacting, their positioning.
How so?
Well, we're seeing this tangible shift, money moving away from areas that maybe felt safer before, like tech stocks, even government bonds.
Huh. Really? Away from bonds?
Yeah, and towards gold, other commodities. It really highlights this big reassessment of risk and where the opportunity might lie now.
Okay, so investors are getting nervous. And it sounds like a major source of that nervousness, that risk, is this escalating trade stuff between the U.S. and China.
Exactly.
Can you maybe break down how that's feeding into the gold price?
Certainly. So President Trump brought back these pretty high tariffs in the first quarter of 2025. We're talking like 145% on Chinese electronics and metals.
Oof, 145%?
Yeah, it's hefty. And that really shook up international trade. Predictably, China hit back.
Retaliatory tariffs.
Retaliatory tariffs, exactly. 125% on U.S. agricultural goods and high-tech exports.
So, okay, tariffs go up. How does that translate directly into gold going up? What's the mechanism there?
Well, think about the broader impact. These kinds of actions, this trade war fitting, it creates a ton of instability.
Right, uncertainty.
Massive uncertainty. Businesses are worried about supply chains. Costs might go up. Production might be disrupted. Investors then look at that and get worried about, slower global growth, maybe even currencies losing value. And historically, when you have that kind of economic and, frankly, geopolitical uncertainty, gold has always been that safe haven.
The flight to safety.
The classic flight to safety. People park their capital there because it's seen as a store of value that can, weather these kinds of storms. There was actually a Times article on April 11th.
Oh, yeah.
Headline was something like, "Dollar at 3-year low, but gold rises to a record high." It drew that direct line between the trade tensions, the weak dollar, which we should talk about, and gold soaring.
Okay, that makes sense. The flight to safety. And you mentioned the weakening dollar. That's another key piece, right?
A very big piece.
The U.S. dollar index, the DXY, it's dropped below 100. First time since 2023, I think.
That's right. And that's a psychologically important level, but it also signifies this broader dip in global confidence in the U.S. dollar.
And why does that help gold?
Well, it's pretty straightforward, actually. Gold is mostly priced in dollars globally, so when the dollar weakens against other currencies...
It gets cheaper for people holding euros or yen or whatever.
Yeah, exactly. It makes gold more affordable for non-U.S. investors. And naturally, that tends to boost demand. Plus, there's the Fed angle. The Federal Reserve has been sending signals about maybe cutting interest rates later in 2025.
Lower rates coming potentially.
And that expectation also weakens the dollar because it reduces the yield advantage. holding dollars becomes less attractive compared to holding assets in other currencies that might offer better returns, or at least stable ones.
So it's like a double whammy for the dollar, which is a double boost for gold.
Precisely. Weaker dollar makes it cheaper to buy, and lower expected U.S. rates make holding dollars less appealing anyway.
Got it. Okay, so trade wars, weak dollar.
Yeah.
You also mentioned central banks buying up gold pretty aggressively, especially China.
Yes, that's the third major driver we're seeing. The People's Bank of China, specifically, has continued to add significantly to its gold reserves. Over 50 tons just in the first quarter of 2025.
50 tons. Wow, what's the thinking there? Why are they doing that?
Well, it seems to be a dual strategy, really. On one hand, it's about diversification, reducing their dependence on the U.S. dollar as their main reserve currency.
De-dollarization, yeah.
Kind of, yes. Okay. Moving away from holding so many U.S. Treasurys, for example. But it's also, about protecting national wealth in what feels like an increasingly unstable global environment. Holding physical gold is seen as a way to guard against shocks, against instability. And it's not just China, by the way.
Oh, wow.
We've seen Russia, Turkey, India also resuming significant gold purchases. It signals this broader trend, this potential shift away from U.S. Treasuries as the ultimate safe asset in the eyes of some pretty major global players. A Reuters piece from April 8th actually pointed to these central bank buys as a tangible factor pushing the rally.
Interesting. So it's like these big state actors are hedging their bets, diversifying away from the dollar standard a bit.
It certainly looks that way. They're preparing for potential future turbulence.
And speaking of turbulence, those concerns about a possible recession in the U.S. seem to be growing too. How does that fit into the gold picture?
Yeah, those fears are definitely swirling. You look at the indicators. U.S. economic growth is slowing down. Job creation isn't as strong as it was. Businesses seem a bit hesitant to invest.
Even though inflation has cooled a bit.
Right, even with inflation moderating. So all that fuels anxiety about a potential recession. And in that environment, the expectation that the Fed might have to step in and cut interest rates maybe as early as June 2025.
That becomes a big deal for gold.
A very big deal. Because lower interest rates reduce the opportunity cost of holding gold.
Right, because gold doesn't pay interest. So if interest rates on bonds fall.
Exactly. Gold becomes relatively more attractive compared to holding a bond or just cash in a savings account that's suddenly earning less interest. And again, as we said, rate cuts tend to weaken the dollar too.
So another boost.
Another boost. It's this confluence of factors, really, all pointing in a direction that's supportive for gold prices right now.
Okay, so we have trade wars causing uncertainty, a weak dollar making gold cheaper internationally, central banks strategically buying loads of it, and recession fears pushing expectations of lower interest rates. That's a potent mix.
It really is.
So given all that, what are the analysts saying? Where did the big financial institutions see gold heading next? Are they bullish?
Increasingly so, yes. The sentiment has definitely shifted. You look at UBS, for example, they're now forecasting $3,500 an ounce by a third quarter of this year.
$2,500. Wow.
Yeah, and they're citing those strong inflows into gold ETFs, the exchange-traded funds, and that continued demand from central banks.
Okay, cool.
Bank of America is even more optimistic, potentially. They've suggested gold could hit $3,800 by the end of the year.
Get out of here. $3,800.
But they do add a condition there that depends on the dollar continuing to fall and the Fed staying, dovish, keeping rates low or cutting them.
Right. Contingent on those factors.
Absolutely. And it's also worth noting, BlackRock, huge asset manager, very influential. They have apparently been increasing their gold allocations within their funds.
Oh, interesting.
Yeah, and a Business Insider piece mentioned they're now sort of considering gold a genuine rival safe haven to U.S. Treasuries, which is quite a statement.
That is a statement. Moving away from Treasuries as the default safe bet.
It suggests a real shift in thinking at the highest levels. And remember, Citi had already predicted back in February that gold could hit $3,000 pretty soon.
And we blew past that already.
We blew right past that. So the momentum is definitely there, and the forecasts are catching up or even trying to get ahead of it.
It certainly feels like there's a growing consensus that there's more room to run. And it's not just the spot price of gold itself reacting, is it? How are the different ways people invest in gold doing?
That's a great point. No, the strength is pretty broad-based across different gold-related assets.
Like the ETFs you mentioned.
Exactly. Gold-backed ETFs, like the big ones, SPDR, Gold Shares, ticker GLD, and iShares Gold Trust, IU. They're seeing record levels of money flowing in.
Why are they so popular?
Well, they're just a very accessible way to get exposure. for big institutions, but also for regular retail investors. You can buy and sell shares easily on the stock market, and it tracks the gold price without you having to, buy physical bars and figure out where to store them.
Right. Much simpler.
Much simpler. Then you've got the gold mining stocks.
Yeah, the company's digging it up. How are they doing?
They're doing very well. I mean, think about it. The price of their product is soaring, but their costs haven't necessarily risen as dramatically, so their profit margins look really good right now.
Makes sense.
Yeah, so major miners like Newmont, Barrick Gold, Agnico Eagle Mines, they've all seen really substantial share price gains just this year. We're talking 40–50% gains in some cases.
Wow. So investing in the miners has been a good proxy play.
It certainly has. And that higher profitability is actually encouraging some of them to speed up expansion plans, look for new deposits, reinvesting that capital.
Okay, so ETFs are booming, mining stocks are up. What about just, old-fashioned physical gold, coins and bars? Is anyone still buying those?
Oh, absolutely. Demand for physical metal is incredibly strong, especially in big consumer markets like China and India. They have a long cultural affinity for gold anyway.
Right.
But this current environment seems to be boosting that demand even further, and it's actually causing some issues.
What kind of issues?
Well, with demand being so high, and maybe some constraints on supply, getting refined gold where it needs to go, plus shipping logistics, it's led to really significant premiums on physical gold.
Premiums, meaning you pay more than the market price.
Exactly. In some places, particularly in Asia, buyers are paying maybe 5%, sometimes even up to 8% above the spot price just to get their hands on physical coin or bars.
Wow, 8% over spot. It really shows how strong that desire for tangible gold is.
It absolutely does. It underscores that for many, there's still no substitute for holding the actual metal. Some reports, like one in Investors Business Daily, suggested these tariff concerns are also partly driving that physical demand. People want something tangible outside the traditional system.
Yeah, I can see that logic. So, okay, looking ahead then. We've covered the drivers, the price action, the analyst views, how people are investing. What are the key things we should all be watching now regarding gold's future?
Well, its path is going to remain really closely tied to those big macroeconomic events and how investors feel about them. Sentiment is key.
So what specific things?
Definitely keep an eye on upcoming Federal Reserve meetings, what they say, what they signal about interest rates going forward. That's crucial.
Okay, Fed meetings. What else?
Inflation trends. Is it staying moderate? Does it tick back up? That influences Fed policy too.
Right.
Any developments, good or bad, in the U.S. China relationship. Trade talks, diplomatic shifts, anything that changes that uncertainty level.
U.S. China relations.
And, of course, keep watching those central bank reports. Are they continuing to buy gold at this pace? That provides a significant floor under the market.
Okay, Fed, inflation, U.S. China, central banks. Got it.
Yeah.
Any wild cards? Any sort of outlier predictions?
Well, some analysts, and you see this in forecasts from places like CoinCodex or mentioned in articles from the New York Post or Barron's, they're floating the idea that if we were to see a really severe global economic downturn,
Like a deep recession.
yeah, something more serious than just a mild slowdown, then the flight to safety could become even more intense. And in that scenario, some believe gold reaching, say, $4,000 an ounce within the next year or so isn't totally out of the question.
$4,000. Wow. That would be something.
It would represent a major loss of confidence elsewhere, but yes, it's being discussed as a possibility in a really negative scenario.
Okay, so let's try and wrap this up. To summarize our deep dive today, it feels like this really remarkable surge in gold prices. It's not down to just one thing.
No, definitely not.
It's this powerful combination, right? You've got the escalating U.S. China trade tensions creating uncertainty. You have the weakening U.S. dollar making gold cheaper globally.
Sure.
You have central banks strategically buying up large amounts, diversifying away from the dollar.
Very important factor, yes.
And then you have these growing fears about a possible recession, which is leading people to expect the Fed to cut interest rates, making non-yielding gold more attractive.
That sums up the key drivers perfectly, I think. It's that interplay between all those factors.
Right. And we shouldn't forget those price milestones we hit, and the fact that major analysts are becoming increasingly bullish, suggesting this might have further to run.
Exactly. The sentiment is strong, and the underlying conditions seem, for now at least, quite supportive for gold.
Which leads us to, I guess, our final thought for you, the listener. With gold now being seriously discussed by major players like BlackRock as potentially a stronger, more dependable safe haven than even U.S. Treasury bonds.
Which has been the bedrock for decades.
Right. The ultimate safe asset. So if gold is challenging that status, what does that really tell you about the, I don't know, the shifting sands of global financial power? What does it say about how we even define stability in the 21st century? Kind of makes you wonder, doesn't it? How these trends might ultimately impact our own understanding of economic security, of investment in this world that just keeps changing. Something to think about.
Please subscribe, like, and comment.